Well, thanks so much for joining us. This panel today is the latest on digital solutions. And what we want to talk to you all about today is where we're seeing digitization in the mortgage process, where it's headed, why it's headed there, why it's important that we're all paying attention to this now, and what are ways that y'all can harness these opportunities, move past the challenges to get to that state. I'm joined with these esteemed panelists. I'm going to ask them each to introduce themselves, and then I'll introduce myself and we'll get started. We'll start with you, Greg.
Can you all hear me? Okay, yep. Sorry, I thought I was going last. My name is Greg Klosterman, Senior Vice President of Business Development for Atlas Title Company. So just a little of my background. I've had a variety of experiences in the industry. I've worked on direct ops, retail, currently in more of the centralized space. I've worked for the traditional largest underwriters, worked for the tech disruptors, worked for the largest and also some of the smallest. So I feel like I have a kind of an interesting experience from the title perspective. So it's nice to meet you all, and thank you for taking the time to come listen to us today.
And good afternoon, Mike Cafferkey with Fannie Mae. I guess a little bit different career path than Greg, in that I've been at Fannie Mae my entire career. I started back in 1985, and a lot of different roles over those years, but the last over 15 years have been involved in kind of developing and managing our e-mortgage program. And I work very closely with the vendors, with our customers, with really all the different parties in the industry on helping make the transition over to eClosings and digital collateral. So welcome today, thanks.
Thanks, Mike. Good afternoon, my name is Teri Pansing. I am the SVP of Corporate Closing at Fairway Independent Mortgage Corporation. Excited to be here today. Thank you, Snapdocs, thank you, MBA, and thank you to all of you for joining. I've been with Fairway for about 8 years now, and 2 of my departments are closing oversight and closing strategy. We've been working on our eClose strategy for more than 5 years now, and really excited to be here today and to engage with this group. Always enjoy talking about eClose, the strategy, and where it's going, which is a lot of what we're going to talk about here today. So thank you for joining.
Thank you. I'm Camelia Martin. I am with Snapdocs. I head up our e-mortgage strategy and industry affairs. The theme on this panel today is like, once you get into the mortgage industry, right, you don't get out. So I'm going on 18 years. Vast majority of that was at ICE Mortgage Technology. I see some old colleagues here in the audience. Spent a couple of years helping Ginny with their digital collateral program, and I've been at Snapdocs for a few years now. One of the things that I want to apologize for in advance is my voice is cracking because I tried to keep up with Maroon 5 last night. But hopefully everybody can hear me and understand me. I'll do my best to project. If at any point, I know it's loud in here, if at any point you guys can't hear me or any of the other speakers, just someone flag us down and we'll do our best to project. So why are we talking about this? Why are we talking about digital closings today? If you look at digitization, the history of digitization in the mortgage industry, we started at the very front, right? We see a lot of investment in the point of sale, making sure the borrower has a really great experience in the very front end, because that's where you're capturing your customer. And then you see a lot of automation, use of AI throughout the loan manufacturing process. And now we're at that final frontier. That last critical mile is the closing. And why do we say it's critical? It's critical because what's the product we're all creating, buying, selling, servicing, funding? If you ask someone that wasn't in our industry, they'd say, oh, well, it's a new home. Or in better years, it's a better interest rate, right? But we all know in this room, the product that we're creating, the product that we're buying and selling, securitizing, is that note, that promissory note, and all of that other surrounding collateral that supports it. And so yet, that part where that product is actually being created and executed is the part that has not seen the degree of digitization that we've seen up front until just recently. So before we talk about what the surveys say, what the case studies say, I want to hear from the group. I want you all to hear from the group about why lenders, investors, title companies are not just for digital closings. Why are they prioritizing digital closings or enabling digital closings, helping to accelerate the industry's adoption? I'm going to go ahead and start just right here to my right, Teri, with you. I know Fairway has been a massive proponent of digital closings, a trailblazer. I think you guys are one of the top digital closing lenders in the country. What was it about digital closings that made that so important and a priority for Fairway?
Sure, thanks, Camelia. For us, it's been a journey over the last 5 years and throughout the various ups and downs in the market, right? It's been really interesting. But I think one of the things that you'll find, not only being in this group and in this room, many of the folks that we already know here, is that it's been very much of a collaboration, a cross collaboration over the years. For us, I can tell you that, you know, our North Star or our showcase of eClose has always been the customer experience. If we can enhance that, you know, again, as we talk about from the very beginning and the basics, customers are, you know, very inclined to eClosing their initial disclosures, their sales contract, the LEs, the CDs, everything up to that point is digitized, right? For us, so it really began with how can we carry that through to the closing? Moreover than that, how can we make the closing experience the very best possible? For us, as an independent mortgage banker, most of our branches, or all of our branches, I should say, rely really heavily on the relationships that they have in their local markets. So that's with their builders, their realtors, their referral partners. And it's really important for us to be able to showcase this as a convenient experience and a superior experience than the old traditional paper closing. And that's really what it's become. In the last 5 years, we say it's really become how we close. We're close to 80% of all of our eligible transactions have some portion, right?
I wanted to make sure everyone heard that percentage.
Exactly.
Say it one more time here.
At 80%, almost 80, right? There we go. But you know, the important thing there is we don't mandate an eClosing. Again, as independent branches and how they operate, we really wanted to gain their trust in the process as a superior experience. Stop telling them about it and more showing them how it works. And I think that that has just been an evolution over the years, a very long, tireless one. But in addition to that, it's working with the partners, right? Working with, you know, not only, you know, MERS and MISMO and our partners, but, you know, also our agency partners, all the way through warehouse partners, our title partners. And we were just talking about this a little while ago, going back 5 years ago. We really found title to be a bit of an obstacle, and I know you're going to talk about that. And, you know, fast forwarding to today, I don't know if I'm just imagining it, but I feel like they're our biggest fan, right? To the time that can be saved, and the feedback that's coming from our borrowers is really everything that we had hoped for in that experience. In that it's fast, it's easy, it's convenient. Most of our transactions are purchases. And those notifications to the borrowers to review and sign their documents come out at midnight on the day of signing or the date of their documents for them to review it. And we find that, you know, we get up and opening business in the morning, you know, on Friday, and we already have 150 to 200 transactions already signed. So, you know, we're just thrilled about that. And they tell us that it's easy, it's fast, it's convenient, and it's reliable. They can trust that process, and that's the most important thing for us, is that our loan officers and our network partners have a lot of faith and trust in the process and putting their borrowers in our hands for that closing experience. So we're very grateful for that. And again, grateful for the partnerships that we have throughout the industry to be able to get here. We certainly can't do it on our own.
So speaking of those partnerships and that example that Teri gave, that I think for a long time, folks at least had the perspective that settlement was a blocker to digital closing adoption. I'm going to turn to you quickly, Greg. Truth, myth, maybe was it true at some point in time and no longer?
I think it's a mix. I actually was coming here today to hopefully just propose we all pick one system, one process. Can we just all vote? But seriously, yeah, I think we were talking about it. I think part of the adoption is the familiarity. So from a title and settlement standpoint, you can imagine we work with all of you. Whether you're directing to us or not, we tend to work with most all the lenders, right? So each person may use a different technology, a different process. So you can imagine that takes some time. We absolutely see the value, and you asked Camelia a little bit about the why. Teri hit on a lot of the benefits, but you know, there are some others. You know, for us, if we can figure out a way to preserve our efficiencies and our cost savings, that helps everybody. So a little bit about Atlas, we're a 3-year-old company, so we had the opportunity to build it with our experience from the ground up. So we didn't have the obstacle of, that many of you may have, legacy systems. How does this fit with new technology? How do they communicate? So we've had that advantage. We also don't have the large branch network. So I know you all experience, ma and pa shops down the street, right? We've got 3, so that brings us a lot more control, I think. So the other piece is the market opportunity for all of us. There's, I think, generally a resistance to change. And so right now there's a lot of talent and good people out there. And so being able to bring in the right people that are aligned with your mission, really eClose, it checks all the boxes for us. As it relates to our goal, we want to be fast. Everyone talks instant, right? Control, quality, those sorts of things, they all tie in very well, I think, with all of our mission. So we're 100% on board.
Great point. So maybe possibly true, change management difficult, but you guys clearly see the value. So Mike, I have a funny way of asking this question because you guys have been doing eNotes for a long time. You've been a proponent of digital closings at Fannie Mae. I was going to ask you, when did you guys have that aha moment? Only because I think you were there at Fannie. If you've been there 25 years, you're probably there when you guys first launched this.
So
Maybe
I was.
not?
I was. Well, I had a brief respite in my career to go be dad for a few years, and then I came back to Fannie Mae to kind of help kick off the e-mortgage program. Back then, really the impetus was around trying to change the borrower experience. Some of you might recall the CFPB did a study and really was trying to promote the value of eClosings in really changing what was really been somewhat of a painful borrower experience. They go through this origination process, and at the end there's this process of signing documents rapidly with traditionally not typically much time to read and understand what they're signing. So really the vision around eClosings was as much about giving the borrowers access to those documents ahead of time so they could read, they could understand what it is they were sign some of those documents ahead of time that didn't need to be signed coincident with closing. So at the final closing, they're really focused on the key documents. So clearly a much better borrower experience, and I think that's where a lot of the early adopters, that's where their focus was. And that's really, from an eClosing perspective, huge benefits to the borrower. But as we turn to our customers, clearly there's tremendous operational efficiencies, and then when you add the eNote into the equation, then there's significant efficiencies in terms of secondary marketing and delivering in the secondary market. So, a big part of what we try to promote and make sure our customers understand is the power of an eNote. Why are we talking about eNotes so much? Well, the reality is that almost really all the other documents that are signed at closing, if they're signed in paper, it could be digitized. It's the note, if it's signed in paper, it's going to stay paper, but if it's signed electronically, now you have an electronic asset. That you have an electronic note, and you can have all the rest of the documents can be digitized, even if they're signed on paper. And so with that electronic asset, now you have the ability to really move that asset much more quickly into the secondary market. Our customers not only are having significant upticks in velocity, but they have much more control and they have much more certainty. So when you deliver an eNote to Fannie Mae, it's really a completely digital experience. You're not using a custodian. That note is coming directly into our vault. It's being automatically reviewed against the delivery data, and that note is being certified for purchase within moments of coming into us. So again, we have customers that have kind of changed their committing behaviors. They're delivering to Fannie Mae under one-day commitments because they know when they hit that button, it's going to be delivered, it's going to be certified, and they're not worried about where that collateral is. So unbelievable experience and power with the eNote. And so that's what, a big part of why we've been trying to promote this, but in terms of the larger eClosing experience, I think it's as much about the borrower as anything else.
I'm going to turn to the data for a second. And before I do that, I want to just make sure that we're all using terminology that everybody understands in the same way. So when we talk about digital closings, when we use the word hybrid, what we really mean is some of the documents are electronically signed and some of them are wet ink signed. When we talk about hybrid with eNote, we mean at a minimum, the eNote, the promissory note is an eNote, so that's electronically presented, signed. And transferred. And then when we talk about a full eClose, what we're referring to is every single document e-signed. Anything that needs to be notarized is using some form of e-notarization, whether that's remote online notarization or an in-person electronic notarization. And if you look at that chart there on the left, what you'll notice is with each document that's electronically signed, the value, the cost savings, the impact is significantly growing, right? So when you've got a hybrid, you're looking at somewhere in the range of $80 to $110 per loan, per file. These are per file numbers. When you're talking about a hybrid with an eNote, you're getting closer to $300 a file, because that's where, again, to the point Mike was just making, you can get those off your warehouse line quickly, you can deliver them to your investors really quickly, and investors like Fannie, Freddie, and some other investors have an auto validation process. Because it's coming in as an eNote, they're able to automatically certify that collateral. Actually, to an extent, bypasses the traditional custodial process. There's not the stare and compare that's needed. And then, of course, that grows when you get more and more digital and you start talking about things like the security instrument with a RON or with an IPEN. I know we've got some RON folks in the room that are smiling at me now. But when you look to the right there, these examples that we're talking about, I mean, some of them are just common sense, right? Anytime you have something that's not in a physical form, it's not a wet ink document, it's virtually impossible for you to lose one of those documents, for it to end up in a shred bin. We had a lender that told us a FedEx truck ended up in a lake. Real story, not making it up. You were there for it. and so all of those things that can otherwise happen to paper that in some cases is worth, on average, $300,000, just can't happen with a digital asset. And so, there's no missing signatures, there's no missing pages, there's automated verifications that can happen because now we're working with a digital document and we have better access to that data. So in case anyone's wondering, where do those numbers come from? It's operational efficiency, it's capital efficiency, and yes, these numbers are gonna look very different from lender to lender. If you've got an organization that's a depository, they're not using a warehouse line, some of those numbers might look smaller, but we all know what we're willing to do to even save $20 on a file. And so I haven't come across an organization yet where digital closings doesn't make sense.
And Camelia, I'll add to that on average, we see eNotes delivered to Fannie Mae 7 days faster than paper notes.
7 days faster.
7 days faster.
And that 7 days can really add up for a lender.
I would concur with that. We're seeing dramatically reduced times to the agencies. I think at one point in time we were at 12 to 13 days in delivery on paper, and we were reduced down to between 4 and 5 with eNotes and eMortgage. And to your point, real story, especially during the pandemic, we could lose tens of thousands of dollars, with notes and things that were lost in trying to recover that along the way with the custodians. But, even today, between, hurricanes or wildfires or, FedEx trucks losing their way in the collateral packages. We had one the other day that the note had been shipped to the wrong custodian, and we were looking everywhere for that note and found it, at an alternate custodian that said, we'll get it back to you here quickly. And by the next day, the wrong custodian had lost the note. So, these things happen, and those efficiencies really are real.
That's a really great point. This is my favorite point to make, Greg, is that, no offense, but as a lender with a digital closing, anything that's digitally signed, you're also not waiting to get back from settlement. You have it immediately accessible to you. If it's something you need to send to a secondary market partner to begin that trade, you can do it instantaneously. And so those are the types of things that we're talking about when we talk about speed and efficiency and agility.
In fact, we've put in additional automation. So if a note comes to us in pre-acquisition, the seller wants it back because our correction, it wasn't intended to come to us for a number of reasons. We have the ability, in many cases, for the lender to self-serve the transfer of that note back, both through our loan delivery system. If there's a data issue, they can trigger the return of the note automatically, so they can perform a correction, so they're not waiting on a custodian or someone to do that. And we also have an automated process by which a form that's submitted to request a transfer many of those now are being processed automatically by our system and initiating that transfer right back. So, I mean, we see corrections happening really quickly with an eNote because the lender can get the collateral back, they can make a correction, they can register a new eNote, they can transfer it back. We've seen this happen in a matter of hours instead of days or weeks.
I would also add, we definitely are very good with not using paper. I think we might kill more trees than John Meacham does. So all the things you're saying, 100% agree. The less touches, the less things we print, have to package, ship, that's all savings to us if we can do that all digitally as well. So,
that's great points. So, if any of you have started down this path and you're working with internal stakeholders, one thing that you're going to hear, if you haven't heard it yet, I promise you will, particularly secondary markets, capital markets teams are going to say, don't do anything that's going to affect the profitability, the fungibility, the liquidity of that loan on the back end, right? Particularly organizations that sell best X may not always know where that loan's going to go to post-closing. And so we did have a very large IMB that was in a very similar predicament. They had a capital markets team that was pushing back heavy and saying, we get it, you want to be digital, we've got to make money, and we want to make sure that we don't leave any money on the table. And so we sort of said challenge accepted, and I wanted to share this output with you guys. So for this particular lender, we said, give us the data. Give us the loans that you've delivered into the secondary market over a period of time. Let's look at the actual bids that you got. Let's put your specific inputs into this model and see whether or not you would have done better if it was eNote or if you in fact did better as best X. And in this instance, the eNote eligible investors were more often the highest bidder, even though they represented less than half of the IMB's investors. And then even when the highest bid came from an investor that didn't accept eNotes, this lender would have netted an additional 5 bips because the capital and operational efficiencies outweighed the delta between the pricing that they could have gotten from an eNote investor and from a non-eNote investor. And so really what this is saying is we need to start looking at the profitability on 2 dimensions, not just the price that you can command in the market, but also what is your cost of goods? What is it costing you to produce that loan? And if you're not looking at both sides of that equation, you're definitely leaving money on the table. I don't know if I actually can't remember if you guys have had a chance to see this. I think we walked through it briefly. Any reactions, any surprises? Again, recognizing that numbers can look very different depending on how an organization is situated. But does anything about this sort of surprise you, or does this seem like something you would expect? Maybe I'll start with you, Mike, because you're an investor, and I think hearing it from you first might make sense.
It doesn't really surprise me, and I think it is very accurate. And I will say that I know that the issue with a number of the investors not being ready for eNotes has impacted a number of our customers' desire or ability to move into eNotes. What we've seen, particularly over the last year, is the adoption has grown, and as I look at the 20 largest sellers that deliver to Fannie, 16 of them now are approved for eNotes. A lot of those are aggregators as well, and so a lot of them aren't doing a lot of eNotes. We've probably seen a handful of customers that have large customers that have scaled. A lot of the ones that are doing primarily eNotes tend to be smaller institutions that maybe are a little bit more nimble in terms of being able to adopt that. But largely we're seeing most of the large customers have adopted or in the process of adopting. So I think in terms of the participation in the industry, it's fairly broad right now. I know there's some important actors that are still missing. We continue to hear, particularly on the MSR side, that there's more investors need to move into that space to give some comfort to some of our customers. But I will say, we are actively reaching out and pursuing and trying to bring more kind of actors into this space. So we have a full ecosystem. But generally speaking, I think that there's fewer and fewer. I think of the consequential companies that at least are not playing with eNotes in some respect. And so if you think the message is that eNotes aren't happening right now, I would say that they are. The numbers are maybe at the industry level aren't, but there's a lot of participation, and I think it is time for particularly the aggregators in the space, to begin looking at it. There are different considerations there, and I would absolutely offer, if you're a Fannie Mae customer and you want to dig into this a little bit, please reach out to us. There's a lot we can do to kind of, I think, help accelerate our customers moving into the eNote space particularly.
I would say Mike returns your call same day too. He's very good at that. So bring the agencies along as your partners. Huge help, lots of encouragement and lots of support. I think for me, one of the things that I've done on a really regular basis is working with our secondary teams to better understand the language, the nuances. We're primarily a direct seller servicer, but it's incumbent to the secondary marketing partners to be having those conversations. And I've seen a lot of that lately, where our secondary marketing partners are encouraging and challenging those lenders that are not correspondent partners, that are not accepting eNotes, to say, when are you going to be getting on board with this? This is an impact. This is a difference. We need you in this space. What can we do to help bring you along? That was the same actually on the warehouse side for us. And I can tell you today we are on the verge, almost at 100% of our warehouse partners that are accepting eNotes. So, being really challenging of those folks and asking them to come along on this journey, and what can we do to get you there? I do really believe in the next year or so that we're going to see more and more of that. And want to thank Fannie Mae for being a part of that, right? Stepping outside themselves to help support others in this initiative, because I think it helps us all globally in the ecosystem.
Greg, would love to hear from you. I know, again, this is focused primarily on the profitability from a lender perspective, but how do you see this impact from your customers, for example? Are you seeing demand, and is it based off of this? Is it based off of customer experience?
This particular slide, I think from our perspective, represents a real quality improvement. So just bringing more control around that closing process and the settlement piece, right? The speed obviously is a benefit, but when you're talking about selling, on the secondary market, that's really a reflection of the product being a more reliable quality product, in my opinion.
I mean, I think part of the number is in order to kind of achieve these advantages, you need to be doing this at some level of scale. And so, clearly doing a handful of eNotes is not going to get you anywhere. It's really trying to re-engineer your processes and really change things to really take advantage of the power of E. We're, as everyone knows, we're in a purchase market right now. As I look at the deliveries that are coming into Fannie, a vast majority of the eNotes that are coming in are on the refi side. It's approaching 25% of refi deliveries or eNotes, whereas on the purchase side, it's much smaller. It's in the neighborhood of about 7%. And as we well know, a lot of that is because of the complexities in the settlement space, particularly on the purchase side. When you're dealing with a third-party agent, if you have the ability to kind of for a refi steer a loan to an agent that's familiar with the closing process and eClosing, it's much easier for refis for a lot of our customers to do eNotes. And so as we look at the purchase side, I think Camelia mentioned this concept of a hybrid closing, and that's something that we talk about with our customers in terms of a good way to kind of enter into the space. So a lot of them are already doing e-signatures on disclosures and things, but the ability to add that eNote into the stack of documents that's signed outside of closing, that's not a notarized document. It's not something that it necessarily has to be signed in the presence of the settlement agent. And so we're seeing more of our lenders that are scaling eNote successfully actually taking ownership over the execution of the note, getting that signed outside and prior to closing. And even if we have a paper closing because it's a settlement agent that doesn't have a familiarity with their eClosing process, they now have an electronic asset. They have an eNote that can be flipped much more quickly into the secondary market. So that model is something we're starting to see take more root, is kind of that hybrid process where the closing is being broken up into the pre-signed docs and then the docs that need to be signed at closing.
I would echo that. Actually, prior to the rate environment we're in last year, when we were all doing a lot more refinance, our pipeline, I spoke to our COO, he said around 60% of the files we closed last year were done in a hybrid environment. So From my experience speaking to people, I think it's fair to say most people are interested in this. I think we all recognize the value. It's just how to go about executing it. And so, to your point, Mike, I think that's kind of the first step for many people, starting with that hybrid process and working and developing from there.
I really want to underscore there were some really good nuggets that just came out of the panel. So I'm going to repeat what you just heard, what you guys just said, just to make sure that these parts really resonated. We didn't talk about this at the beginning. When we were talking about the different digital closing types, one thing to keep in mind is folks start to think about digital closings as one thing. I either do digital closings, it's either a digital closing or it's not. But the reality is digital closings are on a spectrum. Very, very, very few. As a matter of fact, I've come across almost none. No lenders would say, we only close digital closings this way. You have to have a very flexible, agile approach because you're A, meeting your borrowers where they are. Not everybody is a candidate for remote online notarization closing. B, you're also wanting to optimize, right, for your own objectives. It might be you're looking for profitability, which might make hybrid with eNote a better option depending on your investor mix and your geographics, right, where you're closing loans and where RON is accepted. But also it could be sort of a crawl, walk, run approach. Vast majority of lenders need to start with hybrid and then slowly expand their digital closing journey from there. Add eNote. We always recommend start with investors that you do a pretty significant amount of volume with, but also ones that have liberal e-mortgage acceptance policies like the GSEs who have a tremendous amount of resources and again have among the most liberal e-mortgage acceptance policies in the industry.
Might I add something?
You might.
So I think one of the things that we deal with from time to time as well is just notary experience, right? And for those of you that service your loans, or maybe you have a unique product, and so maybe there's a disclaimer or something that you require signed in the package, how many times do those get missed if they're outside the norm, right? As a notary, people are trying to go fast. Sometimes they miss things if they're not looking for it. We do our best. We all put instructions in. Notaries don't always read those instructions, right? So within this process, again, you eliminate a lot of those potential problems to have it customized, templated, required within it to even move forward. So those are other things a little bit outside the norm that I see as a tremendous benefit, because the minute we have to go back to a borrower to sign additional documents, right? We've all dealt with that. It really damages the client experience, your borrower's experience, and that reflects upon you. We realize most people think of us really as almost part of your company, right? So we need to do everything we can really to be almost a silent partner and make it smooth. So
great point. This is also a really good segue. So we've talked about all the benefits. Hopefully you found some of these examples to be pretty compelling. And so the natural question is, well, then where are we at? If this is so great, is everybody doing it? And we recently looked at a survey that was done by National Mortgage News, and they surveyed 100 lenders. This was a mix of banks, IMBs, credit unions, so a nice broad group there that's captured, and it was done just this summer. So 74% of lenders have invested in some form of eClose technology. That could just be something that supports a hybrid eClose, it could be hybrid with eNote, it could be a full eClose, but at least in some form of digital closing technology. Yet only 28% have gotten over 50% of their portfolio adopted as digital. And when we just talked about all of the benefits that you see, I'm sure that you're also wondering, like, well, why is that the case? Why are they not optimizing to get as easy as they can for every single loan? We've got some examples because we asked that question in the survey, but before we pull that up, Teri, you've been through this. I know it wasn't easy. I know at times it was painful. What would you say is probably the reason why we're seeing this delta between those numbers?
I would say it's the commitment to the strategy, right? For us, it's been bringing all of our partners, stakeholders, both internally and externally, so that's all the various departments that touch it, that are impacted by it, bringing them on board. That's everyone from origination all the way through secondary servicing, all the way through. Having stakeholders, having subject matter experts that are able to speak to it, that are able to encourage it, facilitate it. The commitment, right? Showcasing it. Camelia, as you mentioned, start somewhere. You can digitize a closing package relatively quickly, efficiently, easily, and moving into the eNotes takes a little bit more effort. But again, if you have partners to be able to help you get there along the way, and then of course your settlement partners. You mentioned it a little bit earlier. It's once you get to a scale, Mike, I think you mentioned it, once you get to a scaled level of it, and we tell our branches this all the time, you have to kind of achieve scale to really realize some of the benefits, as Greg mentioned, of not having to go back to the borrower. We missed a signature, missing a funding because a package got lost. The experience that in the feedback that you're getting from the borrower's experience, or even the feedback that you're getting from your settlement agents, that's really encouraging to us to hear that they really like it. So, those are the things that we're seeing along the way, is make it part of your strategy, make it part of your commitment to start somewhere, have those both internal and external champions and partners, and set yourself a good solid goal. And for us, it's moving that mark as we go along. But it's really been fun to watch it go and watch it grow over the years.
Mike, you talked to a lot of lenders that are either just starting, just researching, or in the middle of implementing. What do you see the primary challenges that's leading to some of these adoption numbers?
Well, I think Teri touched on a lot of it, but I think there's a broad range of lenders that we work with, some that have been very successful and some that have spent a lot of time and energy and money to put a capability in place that's really not being leveraged. As I think I mentioned before, when you're doing an electronic note in particular, there's just so much change to so many processes. And so there really needs to be a commitment at a very high level and buy-in across the organization. You can't have these pockets of resistance that are pushing back, or you're not going to get off the ground. We used to hear so often from lenders that had implemented, the ability to start doing eClosings and eNotes, that the loan officers had a lot of power within the organization, and for whatever reason, they're obviously concerned about getting their compensation. Anything that's different or changing in the process, they see that as putting that at risk. But we continue to hear that loan officers were an obstacle to an organization being able to scale. So I think clearly there needs to be a high level commitment. There needs to be kind of a paradigm shift. Like this is the way we do business. Instead of opting into that e-sign process, you should be opting out of the e-sign process. It needs to be the norm. Otherwise, you're not going to really realize kind of the advantages of that scale. I'll leave it at that.
Yeah, that kind of ties into what I had been thinking about, and that is the process piece. And what we hear when we're meeting with clients, again, most people I talk to are interested. It's trying to figure out how to go about implementing it. And like Teri said, that process, it can be a little painful in figuring out, right, and working through. And so, I would encourage you guys, if you have specific settlement agents, to involve them in that process and talk through the workflow and where you guys can help each other. The other thing that really I see a lot is that I think is a big obstacle is this could go different paths. So maybe you say, I want to do a full RON closing. That's great. You might be in a situation that the technology doesn't allow it, or the geography and the regulation doesn't allow it. You may have a hybrid situation, but you may have someone that doesn't really feel comfortable, with an iPad or maybe doesn't have a computer. That a little is ridiculous, but you see where I'm saying. So for you as a lender, you're also having to figure out, at least probably 3 different paths that this file could go on. And so how do you manage that within your workflow? So those are very much the conversations we have, because we're trying to come alongside, each of these scenarios. And, the earlier you can figure out which path those are going, the more beneficial it is to everyone, including your borrower, of course. So, what Mike said is start everything as an eClose. Maybe not. I think this is where involving the loan officer as well, and having some upfront questions about how they want to experience that closing process, I think is helpful.
It's a lot of risk right now, right? It's their paycheck. And for us, that's where it comes into, building that trust. Start with really small, attainable goals. Even if it's a smaller e-package that doesn't include the eNote, particular title companies, particular loans. And we work with that, just as Mike said, with our branches that are starting out. We would rather show and not tell. We spent a lot of years telling them what it was going to look like. Now we spend a little bit more time showing them. Start with one loan, start with one relationship, see what that experience looks like. Or we put out a lot of the results. Talk to this branch, don't listen to me, right? Talk to these branches that are 100% in eClose eligible and ask them what that experience has been like. So I think start with small, marginal victories, something that you can start showcasing within your organization, right? Bring in some of your settlement partners that are highly engaged and willing willing technology partners. You pick the borrowers, and we say the exact same thing you did, Mike. Start with an opt-in and then move to an opt-out. And that's really where our closing teams come in, is once we get them comfortable with it, we let the closers talk to the branch about, this is going to be an eClose. You always have the choice unless you tell me that this customer is not the right fit for the technology. So I agree.
So you're still giving them that control or that input about how that closing is going to go. And